As the market is closed for the weekend, with today being Sunday, November 2nd, 2025, we are looking at the final figures from Friday, October 31st. Co-Diagnostics, trading under the ticker CODX, closed the session at $0.46 per share. This was after a loss of 1.75% for the day, or just under 1 cent, on significant volume of over 6 million shares. The stock saw no movement in the after-hours session, holding steady at that $0.46 mark. This $0.46 price, however, is the quiet aftershock of what was arguably one of the most violent and sudden whipsaws investors have seen in recent weeks. For anyone just looking at the Friday close, the story is completely lost. The real story here is not about a one-day 1.75% drift. It's about a stock that gave investors a perfect textbook example of the tension between a promising headline and the brutal reality of corporate finance. It's a story of a 100% gain followed by a 55% collapse, all within a 48-hour window. This is a nano-cap stock living on a knife's edge, and last week's trading action was a masterclass in volatility. Let's establish the common ground, the expectation. On Monday, October 27th, the market believed Co-Diagnostics had found its savior. The company announced a definitive agreement to form a joint venture in Saudi Arabia. This new entity, Co-Diagnostics, was presented as a massive expansion, a partnership to manufacture and commercialize co-diagnostics technology across 19 countries in the Middle East and North Africa. The market reacted with euphoria. The stock, which had been languishing, absolutely exploded, doubling in price. For those holding the bag, it seemed the long-awaited turnaround was finally here. The narrative was set, a new, funded growth story, an entry into a massive, untapped market. Then, the reality set in, and it hit less than 24 hours later. On Tuesday, October 28th, just as the new buyers were celebrating, the company announced a $7 million registered direct offering. The stock didn't just pull back, it collapsed. It fell over 54% in a single session. The truth became painfully clear. The joint venture news, as positive as it was immediately used as a launchpad to raise desperately needed cash. The company sold 12.7 million shares at a price of just $0.55. This was a massive dilution, a gut punch to every investor who had just bought in on the excitement of the Saudi deal. It was a classic good news, bad news scenario, where the good news was simply the bait required to execute the bad news. This recent volatility, this extreme pump and subsequent dump, is not just random noise. It is the direct result of the company's precarious financial position. To understand what is happening with CODX, you have to understand its past and its present. Co-Diagnostics was, like many in its sector, a pandemic company. Its revenue and its brief period of glory were almost entirely built on its Logic Smart COVID-19 PCR tests. The market rewarded them handsomely for this. But as the pandemic receded, so did the revenue. The company's Q2 2025 earnings report from this past August tells the entire story in stark, unflinching numbers. Revenue was just $162,900, a drop of 93.87% year-over-year. Meanwhile, the company posted a net loss of $7.73 million for the quarter. This is the core of the conflict. The company is burning through cash at an alarming rate. Some analysts estimated its quarterly burn to be between $5 and $7 million, while its cash on hand was dwindling. That $7 million offering wasn't for expansion, it was for survival. It was to keep the lights on. The company is in a race against time. It is trying to transition from being a one-trick pony COVID test provider to a diversified molecular diagnostics company, all based on its new at-home and point-of-care platform, the CODX PCR system. This is the future they are selling. The problem? This platform is not yet approved for sale. In fact, the company had to withdraw its 510(k) submission to the FDA for its COVID-19 test back in February of this year, citing feedback on the shelf life stability of a component. They're working on an enhanced version to resubmit, but the regulatory clock is ticking, and the cash clock is ticking even faster. This brings us to the short seller thesis, which in this case is not some complex conspiracy. It is a straightforward fundamental bet. The short position has been and remains a bet that Co-Diagnostics cannot bridge the gap. It's a bet that the company will run out of cash before its new, unapproved platform can generate meaningful revenue. Interestingly, the short seller data from Nasdaq shows that short interest was much higher in late summer at over 1.3 million shares, but had fallen to just 111,000 shares by mid-October. This suggests many shorts may have actually covered before this recent volatility. Now the thesis is renewed. The $7 million capital raise provides only a temporary reprieve. Given their burn rate, this new cash might only last them one more quarter, perhaps two. The shorts are betting that more dilution is not a risk, it's a certainty. And with the stock now trading below the $0.55 offering price, those new institutional investors are already underwater. What's your take on the recent $7 million offering? Was it a necessary survival move or a betrayal of shareholders who just bought the JV news? Comment below. For investors trying to navigate this, it's crucial to know what to look for. You are no longer trading a company, you are trading a balance sheet. The first thing you must do is find and monitor the short interest data. This is typically published twice a month by Nasdaq and other exchanges. It will tell you if short sellers are piling back in. A rising short interest number means the market is betting the new cash is not enough. Second, you must watch the cash balance like a hawk. The next major event is the company's third quarter 2025 financial results, which they've announced they will release on Thursday, November 13th. This earnings call is everything. Management must provide a clear, confident update on their cash runway, the status of the FDA resubmission, and any tangible near-term revenue expectations from the new Saudi joint venture. Any hesitation will be punished. The retail sentiment on forums is, as you can imagine, completely torn. You have one camp of long-term holders who genuinely believe in the CODX PCR technology and see the Saudi joint venture as a brilliant long-term play. They view this $0.46 price as the absolute floor and a generational buying opportunity. Then you have the other camp, composed of traders and betrayed investors, who see a management team that just destroyed shareholder value to buy itself a few more months. They point to the fact that the stock is non-compliant with Nasdaq requirements, likely for failing to maintain a $1 minimum bid price, as a sign of deeper distress, which could eventually lead to a value-destroying reverse stock split. This leads to the second question for our community. Do you think the Saudi joint venture is a real, long-term growth driver, or was it just a headline to get a dilutive offering done? Looking forward, the path for CODX is binary. The bull case, the expectation, is that the $7 million is the last bit of fuel needed to get the rocket to the launch pad. In this scenario, the Q3 earnings on November 13th are better than feared. Management provides a clear timeline for the FDA resubmission. The Saudi partners place an initial tangible order, proving the JV is more than just a press release. The shorts get scared, the stock regains compliance, and the focus shifts to the new platform's commercialization. The $0.22 52-week low is left far behind. The bear case, the reality many fear, is that this $7 million is just good money after bad. In this case, the cash burn continues unabated, the FDA resubmission is delayed again, the Saudi joint venture, like many international JVs, gets tied up in regulatory bureaucracy and doesn't produce $1 of revenue in 2026. The company is then forced to do this all over again, another dilutive offering or worse, a reverse stock split to maintain its Nasdaq listing, wiping out even more value. In the end, the story of CODX is a harsh lesson. The expectation, fueled by a headline-grabbing joint venture, was a return to growth. The reality is a company in a desperate race for survival, forced to dilute its most ardent believers just to keep the lights on. The battle over the $0.46 stock is not about where the company has been. It's about whether it will even exist in its current form to see where it's going.